it's been a tough start to the year. But to give some context, it wasn't totally unexpected because we knew this price increase had to take place. Okay, and we wrote about it at the beginning of the year that we had to normalize, and higher interest rates will mean lower equity prices. And so that we, a lot of funds we've gotten more defensively positioned to reflect that. So it wasn't totally unexpected. But the pace at which it happened and has unfolded went much faster and further than expected. So we expected that 3% interest rate level, for instance, that we got to at the end of April, early May. We thought that would get there by the end of the year. So it happened in a very fast pace. And that's part of the reason why the sort of the market behavior has been a lot worse. And if you think it's been a tough year, just put a couple of little factoids that don't mean much out there, but that that are good stories. I mean, this has been one of the worst starts for the S&P 500, since the 1930s. Okay, it is that bad. And if you look at the bond rates, when interest rates go up, bond prices go down. For the U.S. 10-year bond interest rate, and that is kind of one of the benchmark rates at which all global asset prices are really priced. It is one of the most liquid, most important financial markets out there. But for the U.S. 10-year bond market, this is the worst start to the year since 1788. Okay, that's a long time. Okay, but it shows that in the first half, there's been nowhere to hide, John.